All right, let's kick things off with an intriguing topic that's been making waves in the Toronto real estate market. Power of sale listings are on the rise. Steve, what do you think? Is this an opportunity for buyers or a cautionary tale?
It's a complex situation, Sandy. While power of sale listings might seem like a golden opportunity to snag a property at a lower price, there's a lot more beneath the surface. These listings are essentially properties that lenders have put on the market after homeowners have defaulted on their mortgage payments. So, while the numbers can look enticing, there are significant risks involved.
Exactly. The Toronto Regional Real Estate Board data shows that power of sale listings have increased in the downtown core, 49 listings this year alone, which is quite a jump from previous years. But John Pasalis, the president of OSFI Realty, cautions that the idea of scoring rock-bottom prices is often a misunderstanding.
That's right, Sandy. By law, these properties must be sold at fair market value. This means that the lenders have to aim to get a price that's reflective of the market to avoid any legal repercussions from the original homeowners. So, the deals aren't as steep as some might hope.
Still, there seems to be some room for negotiation. Daniel Foch from Valerie Real Estate points out that about 80% of power of sale properties sold below the asking price, with an average discount of around 5%. So, a condo listed at $500,000 might sell for about $475,000.
True, but buyers need to be aware of the risks involved. Michael Clark from Corman and Company advises caution, as these properties are typically sold as is, and buyers could end up with unforeseen issues like structural flaws or unpaid utility bills. These might not be immediately evident, and the buyer has little recourse.
And it's not just the physical condition of the property that's a concern. The original owner can settle their debt with the lender up until the closing date, meaning the deal could fall through at the last minute. This uncertainty can be particularly challenging for first-time buyers who have already made plans to move.
Absolutely, Sandy. This is why these listings might be more suited to seasoned investors rather than first-time buyers. Investors often have the flexibility and experience to handle the unpredictability and potential risks associated with power of sale properties.
So, in essence, while there might be opportunities for discounts, power of sale listings come with their fair share of challenges. It's important for buyers to weigh the potential savings against the risks and uncertainties.
Exactly. It's a delicate balance, and anyone considering this route should do their due diligence and work closely with a knowledgeable real estate agent. This is definitely a scenario where experience and caution can make all the difference. Sandy, the Canadian housing market's affordability is a hot topic right now, and it's a bit of a mixed bag. We've seen some movement since the Bank of Canada's rate cut 3 weeks ago, but it's not uniformly positive across the board.
That's true, Steve. In some places, like Toronto, we're seeing a rebound in home sales. The Toronto Regional Real Estate Board reported an 8.5% year-over-year increase in sales for September. But the average price is still 4.7% below last year's levels, which might be enticing for buyers.
And that's the thing. Toronto's market is showing signs of recovery, with sales outpacing new listings, which is a good indicator for potential stability. But Robert Hogue from RBC pointed out that the recovery is still uneven and fragile. Only those with stable incomes and down payments should be diving in right now.
Absolutely, Steve. There's a lot of uncertainty, especially considering the economic backdrop and potential trade tensions. But for those ready and able, this could be a rare window to buy in Toronto before any further rate cuts push prices back up.
On the other side, Vancouver is leaning more towards buyers right now. Inventory is significantly higher than the 10-year average, and sales are down by 20%. The Greater Vancouver Realtors reported a 3.2% drop in benchmark home prices.
Right. And according to Andrew Liss from the Greater Vancouver Realtors, the market is expected to stabilize as we approach the end of the year. But for now, it seems buyers have a bit more power in negotiations than they've had in the past.
In Calgary, it's interesting because the market is shifting from a seller's market to a more balanced one. Home sales fell by 14% in September, and supply hit a 5-year high. This has pushed the average price down by 4% from last year.
And that's creating an opportunity for buyers, at least temporarily. Anne-Marie Lurie from the Calgary Real Estate Board highlighted that with more homes on the market, buyers have more choices. But, as she noted, this could change if interest rates drop further and reinvigorate demand.
So, overall, while there might be opportunities for those looking to buy, they should proceed with caution. The market is anything but predictable right now, and buyers need to be prepared for the swings.
Exactly, Steve. The key takeaway here is to do your homework, assess your financial stability, and work with a knowledgeable agent. The market's current state might offer some rare opportunities, but it's crucial to stay informed and prepared for any shifts.
Sandy, the Office of the Superintendent of Financial Institutions, OSFI, recently released its fall outlook, and it's raising some eyebrows with the persistent risks it highlights in the Canadian housing and economic landscape.
That's right, Steve. OSFI's report flags several challenges, including rising delinquencies, a weakening condo market, and the ongoing uncertainty surrounding tariffs. But it also emphasizes that Canadian lenders are showing resilience in the face of these challenges.
Absolutely, Sandy. OSFI's update is part of their semi-annual risk outlook, and it paints a picture of a weaker economy affecting cash flows and collateral values. The report specifically points to the uncertainty over tariffs, which is impacting lenders, borrowers, and businesses alike.
And the housing market is feeling the strain. According to OSFI, activity is below the 10-year averages, and prices are continuing to soften. The condo market, particularly in the Greater Toronto Area and Greater Vancouver Area, is under significant pressure.
Exactly, Sandy. Delinquencies are nearing pre-pandemic levels, especially in fixed-payment variable rate mortgages and self-employed loans. Toronto is leading the charge in delinquency rates, with the condo segment proving to be the weakest link.
It's concerning, Steve. Oversupply in new multi-unit constructions is pushing down prices and could dampen investor interest in future projects. This not only affects collateral values, but also employment in the construction sector.
OSFI does note that the risk of mortgage payment shocks has eased slightly with the Bank of Canada's 7 rate cuts since June 2024. But they caution that borrowers renewing loans originally taken at historically low rates will still face significant payment increases.
That's a critical point, Steve. With nearly one-third of all outstanding mortgages set to renew by 2027, borrowers need to prepare for potentially higher payments, even if the rate cut has provided some relief in the short term.
OSFI is responding by tightening its oversight on mortgage underwriting and the use of blanket appraisals. They're also focusing on the recently introduced loan-to-income measure and how lenders are managing risks associated with variable rate, fixed payment mortgages.
On the funding side, OSFI is advancing revisions to its liquidity adequacy requirements and monitoring how institutions manage liquidity, particularly at their foreign operations. They're keen to ensure that financial institutions are prepared for potential stress events.
It's clear that OSFI is taking a proactive stance, Sandy. They're emphasizing the importance of institutional preparedness, given the potential for broad financial market strains due to the ongoing uncertainties.
Definitely, Steve. The key takeaway from OSFI's outlook is the need for vigilance and readiness among lenders and borrowers alike. The economic environment is fraught with challenges, but with careful management, Canadian financial institutions are well positioned to navigate these risks. All right, Steve, let's dive into the latest on mortgage rates. It seems that the markets are buzzing with anticipation about the Bank of Canada's next move. The odds are climbing for a potential rate cut at the end of this month.
That's right, Sandy. Analysis by LSEG indicates a 64% chance of a 25 basis point cut on October 29th, which is up from just 50% last week. This shift is partly due to expectations of some less than ideal numbers in the upcoming labor force survey.
And it seems there's more to it than just the domestic data. Comments from U.S. Secretary of Commerce Howard Lutnick about the United States stepping back from buying Canadian-made cars and the former free trade agreement add another layer of complexity.
Exactly, Sandy. It highlights the interconnected nature of our economies and how external comments can impact market expectations. The upcoming labor force survey and inflation figures will be critical in shaping the Bank of Canada's decision.
Now, if we look at the current mortgage landscape, there's an interesting dynamic between fixed and variable rates. As of now, the lowest available variable rate mortgage sits at 3.70% for a 5-year term, while the cheapest fixed rate is a 3-year term at 3.69%.
And for those looking at a 5-year term, the fixed rate is slightly higher at 3.89%. If the Bank of Canada does cut rates, we might see variable rates dropping below fixed rates, making them more attractive again.
That's a good point, Steve. For many Canadians, a lower variable rate could offer some financial relief, especially if they're feeling the pinch from other economic pressures. But it comes with the uncertainty of future rate changes.
True, Sandy. It's a balancing act. Home buyers and those renewing their mortgages need to weigh the potential savings against the risks of variable rates. Working with a good mortgage broker can help navigate these choices.
Absolutely, Steve. With the market's current unpredictability, it's crucial for Canadians to stay informed and consider their options carefully. Whether it's fixed or variable, the right choice depends on individual circumstances and risk tolerance.
Sandy, let's talk about the latest employment figures out of Canada. The economy added 60,400 jobs in September, which was a pleasant surprise compared to expectations.
It's definitely a significant number, Steve. Full-time positions led the way, and while the jobless rate stayed at 7.1%, the increase in employment suggests some resilience in the job market, especially in light of ongoing trade tensions with the United States.
Right, Sandy. The manufacturing sector, in particular, saw a notable increase with 27,800 new jobs. While this wasn't driven by the auto industry, it indicates that some parts of the sector are finding ways to thrive despite tariffs.
And it wasn't just manufacturing. Other sectors like agriculture, healthcare, and services also saw job gains. This broad-based growth is encouraging, but we should remember that the labor force also grew by 72,300, which is why the unemployment rate held steady.
Indeed, Sandy. The increase in the labor force shows that more people are looking for work, which could be seen as a positive sign of confidence in the market. However, it also means that the job gains didn't lower the unemployment rate.
That's true. The employment rate ticked up slightly to 60.6%, showing more of the working age population is employed. But, as Charles Saint-Arnaud from Alberta Central pointed out, a strong month doesn't necessarily create a new trend.
Exactly, Sandy. We've seen fluctuations before. For instance, June had a high number of jobs added, but then we saw losses in July and August. So, while this report is positive, it's crucial to look at the broader picture.
And Andrew Grantham from CIBC mentions that despite this month's gains, the 3 and 6 month averages are still soft. This suggests that there is still slack in the labor market, which might justify further rate cuts from the Bank of Canada.
Yes, the odds for a rate cut at the Bank of Canada's October decision have reduced to 25% from about a coin flip. But economists like Bradley Saunders from Capital Economics believe policymakers might wait until December to cut rates again.
That's a possibility, Steve. The private sector added 21,900 jobs, while the public sector saw an increase of 30,700. Alberta led the regional gains with 42,500 new positions, and Ontario followed with 8,800. Wage growth for permanent employees remained steady at 3.6%.
It's interesting to see how these numbers play into the larger economic narrative. The loonie strengthened against the US, dollar following the jobs report, and Canadian debt saw some movement with yields rising slightly. It's a complex picture, but the resilience in the job market is a positive sign amid economic uncertainties.
Steve, let's turn our attention to the Halton region, where we've seen a notable jump in home prices. In September 2025, the average price for a home in Halton region hit $1.19 million. That's a 2.2% increase from August, but it's still down 5.5% from the same time last year.
That's an interesting development, Sandy. It seems like the market there is experiencing some volatility. An increase in month-over-month prices suggests a bit of recovery, but the year-over-year decline indicates there's still some lingering softness.
Indeed, Steve. The Toronto Regional Real Estate Board reported that there were 585 home sales in September, with properties staying on the market for an average of 36 days. That's an 8.9% increase in sales compared to last year, which could signify that buyers are starting to regain confidence.
And with 3,130 active listings at the end of September, up 24.7% from last year, there's clearly more inventory for buyers to choose from. This could be driving some of the price stabilization we're seeing.
Right, Steve. Detached houses in Halton average $1.49 million, which is up slightly from the previous month but still down 10.2% year over year. It seems like buyers might be taking advantage of these lower prices compared to last year.
Exactly, Sandy. And it's not just detached homes. Semi-detached houses saw a significant month-over-month increase of 5.4%, although the year-over-year change is marginal. This might reflect a shift in buyer preference towards more affordable options.
Townhouse-style condos also saw a rise, both month-over-month and year-over-year. They averaged $788,771, up 5.5% from August and 2.4% from last year. This could indicate a growing interest in these types of properties, possibly due to their relative affordability compared to detached homes.
It's a similar story with apartment-style condos, which saw a small month-over-month increase, but a slight year-over-year decrease. This segment seems to be the most stable, which might appeal to investors looking for consistent returns.
And when we look at the long-term picture, home prices in Halton Region have risen significantly over the past decade. Compared to September 2015, prices for all houses and condos have increased by 79.8%. That's a substantial gain, reflecting strong long-term market growth.
It certainly paints a picture of resilience in the Halton region's housing market. Even with the current fluctuations, the long-term trend seems positive. It's important for both buyers and investors to keep this context in mind when making decisions.
Absolutely, Steve. As always, it's crucial for anyone involved in the real estate market to stay informed and consider both the short-term changes and the long-term trends.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time, and stay informed with the latest industry insights.